This is a very heavy Carrara marble sculpture of Virgil, probably the most prolific of the classical poets. He led Dante through the Inferno, and most people don't realize this, but he was actually one of antiquity's greatest options traders. And today, he's going to help me guide you through the underworld of options contract selection. Hi everybody, my name is Frank Bunn, and I've been teaching people how to navigate the securities markets since my friend's 21-year-old was 6 months. Okay, we're going to talk about options contract selection because selecting the proper contract to trade is 99% of the game. All right, so as we know, options, the premium or the value of an option contract derives from three things. It's either time, volatility, or the underlying asset. All right, so today we're just going to focus on time. We can talk about the other ones later. Okay, so time to expiration. A contract has a certain amount of time to expiration. So when we talk about the weekly options, those are going to be 1 to 5 weeks expiration. Monthly are going to be anywhere from 1 month to generally 11 or 12 months. Those options durations, and then obviously your leap, which most people don't know what this means. Leap is a long-term equity anticipation contract. So these leaps are going to be anywhere from like 1 to 3 years. All right. So understanding the structure of these in terms of time is going to enable us to avoid what is called the wasting asset cycle. So each one of these contracts has a wasting asset cycle. So in order to understand the wasting asset cycle, you got to understand what happens with one of the Greeks, and we're going to make this really simple, called theta. And theta is the rate of decay. All right, meaning this is how much money is lost or how much a contract depreciates as long as it is out of the money, in theory, on a linear scale from now, this point in time, until expiration. All right, so you got to understand that in order to get to the next thing. Okay, so what we want to do is we want to avoid, we want to minimize the effects of this rate of decay. So how we're going to do that is, now you understand what theta is, we could take a look, because theta is not linear. You might think that theta is this linear thing that moves really smoothly from, let's say, now until options expiration in, let's say, May. All right, it's currently February, or March, so we're going to say 2 months. So we might think that this just happens in a slow, steady increment. It does not. How it works is like this. Okay. All right. So theta can be relatively low until it goes parabolic. It goes parabolic during the wasting asset cycle. Most people don't know this, called the WAC or the WAC. All right, now that we understand that, we can take a look at what happens. So we're going to start with monthly options. All right, so monthly option is, again, these are 30-day these are 30-day expirations. Okay, so what happens is, let's just say the wasting asset cycle for those is going to be 30 to 60 days. All right, meaning if if it's currently March, all right, we understand direction, we know how to take advantage of direction, we know how to find low risk entries. It's currently March. If we're looking at a July expiration date for that, we will have very, very steady theta, all right, until around June. In June and July, we will hit the wasting asset cycle. This is very powerful because if we can avoid theta, we can treat this option like a stock, like a surrogate for stock shares. Very, very powerful because we can get the leverage without the expense of buying the shares, but it has to be done properly. Okay, so now that we understand that, what most people do is everybody learns to trade cheap options. All right? Now, options are cheap because of two reasons. One, they're very close to expiration. So they're close to expiring. All right? It's one. Two, they're cheap because they're out of the money. All right? There are two things that kill options traders. All right? They're close to expiration. That means that you've hit the parabolic wasting asset cycle. Okay? If they're out of the money, meaning which we'll discuss in another segment. They're out of the money, they're too far away, meaning you end up with what's called volatility burn. We're going to focus on number one because we don't want a cheap option. You should have enough cash to play it right. Cheap options are a loser's game. Okay, so now, in order to make the proper selection in terms of time, we want to avoid the wasting asset cycle. Okay, so for weeklies, okay, this is going to be the last week. For monthly, 30 days, this is going to be 30 to 60 days. And then finally for leaps, okay, this is going to, again, it's going to be the same thing. It's going to be the 30 to 60 days. So if you take a 1 year leap, believe it or not, and it's at the money, you can enjoy 10 months of very, very low theta. Theta will not accelerate, decay will not accelerate until that wasting asset cycle. It's very, very powerful. Most people don't know this. They trade them very close to expiration and they get burned. All right, so if you're trading the weeklies, you want to avoid the last week. In other words, you want to price that out 2 to 5 weeks, okay? Now, this is very powerful because if we apply a risk game, all right, so what we're going to do is, so now we understand market direction, so we can take low risk entries with the expectation of, again, our 5 to 10 times risk, and we're going to fix risk down here. All right, so if I'm thinking if I have a low risk entry in XYZ, all right, I can look at a contract, and let's say I'm going to do a monthly for this. Okay, so I can give myself plenty of time. So I can select a quasi leap for doing that. So let's say it's currently March, all right, and I want to get a low risk. So what I'm going to do is I'm going to shop a June or July contract, all right, which will give me very, very low theta, all right, until roughly May, all right. This gives me 2 months with very, very low theta to achieve this objective. So I get all the leverage, and yet I get very, very low theta or low decay. Right? If I'm looking at a weekly, let's say that I'm looking at a shorter term. Let's say I'm looking at an hourly interval and I'm looking at weekly. Okay, so what I would do then with currently then I would look probably so it's the beginning of March, let's say. So if we're looking at weeklies, so what I'm going to do is I would probably shop like the 3rd and 4th week of March. Okay, 3 weeks out gives me time to get my price rejection following my low risk entry and low theta. I won't lose that decay. Now, a whole lot of good things happen here. What happens when you do this is properly is your contract becomes a surrogate, is a stock share surrogate. Okay? Meaning it will appreciate as your stock appreciates, and we'll get into the reasons that they don't in another segment. But so using time as your primary selector and avoiding the wasting asset cycle makes a huge difference, allows you to play the risk game properly, give your position enough time to achieve its objective without the pitfall of theta that plagues most options traders. You can thank Virgil for this. He is the mastermind, taught me everything I know. He just doesn't say a lot. Okay, if you want to learn more about options, I have a free resource link below this video. If you also want to find out how to take low risk entries, which is what you really should do first, because getting low risk directional entries is the key to making huge option gains, you can also join my free training. There's a link below in this video. And that should do it for today. Don't leave home without properly selecting your option contract. Thank you, everybody, and we will see you next time.